It's Friday, June 12th. I'm Brian Walsh, and welcome to This Week in Impact, where I talk with ImpactAlpha journalists and editors about some of the most interesting impact investing stories we've been covering. This week, I'm joined by editor David Bank. We'll discuss why European battery makers are pivoting from EVs to grid storage. Plus, S2G makes $1 billion bet on the so-called missing middle financing gap, profitable industrial and operational businesses that are poorly suited to both traditional venture or private equity structures. And finally, the World Cup kicks off this week amid sportswashing criticism due to its $400 million Saudi Aramco sponsorship. That's all coming up on This Week in Impact. Hi, David. Welcome back to the podcast. How are you doing today?
I'm doing great, Brian. How are you?
Doing well, thanks. All right, first up this week, Danielle Rossing reported for us how the battery companies that were intending to power Europe's EV revolution are now being redirected into battery energy storage systems. David, what's driving this shift?
Well, the EV market is softer. The Chinese competition is tougher. But the opportunity for grid-level storage for renewables is booming, and it's not just in Europe. The deployments of BESS, battery energy storage systems, is up to like 100 gigawatts a year and growing fast, and costs are falling fast. It's an interesting example of how the energy question generally, but certainly batteries have become a tech story. So they're on the same kind of cost curves as, chips and solar panels and any kind of mass produced, technology driven product. Grid storage in particular, because people might know about, the constraints of rare earth minerals, constraining batteries. When you don't have to move it around, like in a car, you can make batteries out of much cheaper and heavier materials like zinc, sodium, iron, which are much more plentiful.
Yeah, I was struck by the point in Daniel's article that wind and solar are now nearly account for half of European power. And so they really do need that kind of storage systems to help get the overall benefit there.
Well, it's not only that. I mean, yes, it's growing. It's growing fast in part because of the war in Iran, but in some cases, with wind power, even with solar power, it is so cheap and so plentiful that it actually has what they call negative pricing, where you're actually paying other systems to take your power. And so, if you could store that, because the sun only shines during the day and the wind is intermittent, if you could store it so that it becomes what they call dispatchable power or baseload power, then it's much, much more valuable, because now you have foreclosed the need for that gas-fired plant, and now you have something that you can use to balance the grid, and so the utilities will pay more for that. They'll pay surpluses for that kind of dispatchable power, and all of a sudden the economics of renewables completely changes, as well as the physics that are required to make renewables much more than half, but essentially all of the power grid really relies on batteries.
Yeah, so this was, at first there was a concern because there were some of these EV battery companies who were going bankrupt in the European market due to these Korean and Chinese competitors. But now there are these kind of tailwinds that are helping them kind of take advantage of these really booming economics of scale here.
Yeah, well, there was, the hype cycle, as we love, Brian, that, and batteries were very hot. People talked about the battery belt in the U.S. and in particular with the Inflation Reduction Act. The battery investment was off the charts a few years ago, and then it, as you say, has cooled considerably. There were a huge and very well sort of publicized blow up of something called Northvolt in Norway a year ago, and then even a somewhat less publicized blow up just last month of Morrow in Sweden. So the bloom was off batteries, but again, technology kind of finds a way. The economics are so compelling that this grid storage market has really become the new frontier. In Europe, there's lots of policy tailwinds pushing that kind of investment. But interestingly, in the U.S., where EV subsidies, other kinds of electrification subsidies were eliminated in the One Big Beautiful Bill last year. Battery battery storage, and particularly battery storage for grid systems, were not touched. So they still have policy support even in the U.S. So you've got, on the one hand, the slowdown in EVs, and then you've got the other hand, this policy support for grid storage, and that's why it's taking off in both the U.S. and in Europe.
All right, now, David, just to clarify, when you said that these battery companies blew up, you don't mean that literally.
No, I did not mean that they actually caught on fire and blew up, although there have been some notable fires, in particular out here in California at a Tesla battery array down in Moss Landing that did catch on fire and burned for quite a while.
But you meant that they blew up in the sense of they went bankrupt.
They filed for bankruptcy. They did not explode. Exactly.
But one thing that's interesting is that these failed EV battery companies kind of created this talent exodus that is now feeding this new wave of battery energy storage systems.
Yeah, and they're kind of beating a path to Europe because of these demand and the policy environment. There's a company in San Diego called Nuvve, Nuvve, that was doing a vehicle to grid, which is an interesting technology, using your car battery as essentially the home battery, and even a load balancing battery for the grid. But they're now in Europe building these BESS systems. And I love the quote that Danielle used from the executive, talking about a beautiful sunny windy day in Bucharest, Romania, and thinking about the $5,000 per megawatt that they can get from arbitraging, as they say, this energy power as pricing for electricity fell below zero. So people are playing the market, and the market is very vibrant. And again, it's subject to all these levers that can be pulled from the time shifting of the batteries to the arbitrage play for the utilities to the grid balancing and all these advantages that are coming as batteries and grid become just another kind of interactive, programmable digital network.
It's exciting when the economics work out in this way, so that the incentives are aligned, so that more money is being poured into these new technologies that are kind of helping increase the demand for renewables and make the costs cheaper overall.
Yeah, the economics are kind of inexorable.
All right, well, you can read Danielle's piece on the European battery markets, pivot from EVs to storage, on ImpactAlpha.com. There's also a link in our show notes. Later in the show, we'll discuss sports washing criticisms against the World Cup. But for now, we'll take a quick break. When we come back, how S2G, incubated in the family office of a Walmart heir, has gone on to raise $1 billion in outside capital. Next up, Eric Stein reported this week on the recent billion-dollar close of S2G Solutions Fund 1. Now, David, S2G, short for C to Growth, started as a $100 million investment out of the family office of Walmart heir Lukas Walton back in 2014. Before we get into how it has evolved in recent years to manage outside institutional capital, what is S2G's investment approach?
Yeah, it's kind of interesting now. We kind of blithely slide over the $1 billion raise for what is inarguably an impact fund. In the old days, we would get excited about $100 million. And some of the big private equity funds, TPG, Brookfield, Bain, et cetera, have raised north of $1 billion. But this is a purpose-built impact fund that's now got $2.8 billion under management. And as you say, they carved out a place in the ecosystem that is amenable to those kinds of large checks. And it's essentially this gap when companies have gotten over, we've talked about the first of a kind gap, but they have commercialized, but now they're really ready to scale up. And the impact thesis is those are the companies that can get to very large scale impact as well. They're selling lots of stuff. They're installing lots of systems. And so therefore the impact, if indeed you could chart it at energy savings or sustainability kind of metrics and other kinds of things, has the potential to be very large. And so they write these big checks for companies that are ready to grow. Sometimes those might be private equity buyout opportunities. Maybe they're a little bit early for that, but in that case, the private equity is looking to kind of milk the profit streams or the cash flows and not necessarily grow them. On the other hand, there may be too big for classic venture capital. So they take minority positions like venture capital, but they put in big checks like private equity and in these high impact companies. And so they've found a niche there, and they're doing it across materials. They're doing it in a big oceans fund that they think there's a potential for large kind of savings in greenhouse gas emissions and other things in the maritime industries. So it's really come out of the gates as a big player and a sort of particular niche in the ecosystem.
So this missing middle, as they put it, or the third way, so as you said, not early stage venture, not late stage buyout, what are the check sizes they typically write from this fund?
They're talking about like 25 million to 100 million in each company. They just put 50 million into a company called Anna in Nevada, and it makes this kind of generator that reduces diesel consumption at industrial sites and data centers and that sort of thing. And so, it's a very prosaic business, diesel generators, but diesel generators that are 70% more efficient, arguably a better thing. And that company had just grown up. It had never had outside capital. S2G put the money in. They ramped up production and they've tripled their revenues. It's that kind of equation they're looking for. They just did a study. They looked at something like 280 climate-focused ventures, and they found that what people had called growth stage, which you'd think would finance this kind of growth, were actually companies generating less than 50 million in revenue, sometimes not generating any revenues at all. And they said that the capital that has been kind of marketed as growth stage has really functioned really as early stage venture. So again, they kind of did a very nuanced market analysis where they could actually play a role with large checks so that they could put large amounts to work.
Right. And I think this is part of their broader thesis that climate investing is really shifting from these breakthrough bets to adapting the physical economy as it exists. So the industrial efficiency plays or aquaculture or backup power or things like that are really just coming to bear in a resource constrained world.
Yeah, and make that institutional ready, I think would be their argument too, because you want to get, if you're a fund manager, you want to raise big funds, get lots of fees, but on the same token, your LP backers, the pension funds, the big family offices, sovereign wealth funds, want to put big checks out there for their own sort of efficiency, transaction cost kind of reasons. And so if you can have a compelling impact thesis that can also absorb large checks and put large checks to work, you actually have a good fund management business. And so this is an interesting example of as you said, Lukas Walton and Builders Vision, his family office, seeding S2G 10 years or so ago, and then proving out a way to bring in other capital, and now at a fairly large level. So you've taken the original stake, as you said, $100 million, and I think maybe Lukas and Builders Vision is in it, in subsequent rounds, but raising much more outside money as well. You've actually catalyzed some capital.
Right, and so they've gone from a single LP, being the family office, to bring in these outside investors. Who are some of the outside investors that are coming into this fund?
Well, we would love to know, and they're not saying, and all they're saying is, European, Asian, and North American, family offices, institutions, pension funds. So, we'll find out over time, but they're playing it close to the vest right now.
All right. Well, if you know who their outside investors are, please do drop us a note. We'd love to find that out. All right. Well, you can read Eric Stein's piece on S2G's billion-dollar close of their first fund on ImpactAlpha.com. There's also a link in our show notes. For now, we're going to take one more quick break. When we come back, as the World Cup opens this week, criticisms of sports washing for the oil and gas megacorp Saudi Aramco. Finally this week, the 2026 World Cup is projected to be the most polluting football tournament in history. 9 million plus tons of CO2 equivalent, nearly twice the average. ImpactAlpha contributing editor Dmitry Yoshelevich wrote about claims the World Cup is contributing to sports washing for big oil, with a $400 million sponsorship deal with the world's biggest oil company, while players are literally worried about heat stroke on the field. David, we've talked about greenwashing and impact washing and pink washing. What is meant by sports washing?
Well, sports is, where it's at. I'm going to tune into the World Cup here just as soon as the Knicks Spurs finals in the NBA is over. But everybody's watching sports these days, and it's kind of one of the few kind of collective, TV experiences that we have anymore. And so, it's a natural for advertisers, and in particular, fossil fuel advertisers. And Saudi Aramco, as you said, the world's largest oil company, is a major sponsor of FIFA, the governing body for the World Cup, to the tune of $100 million a year for 4 years through 2027, and that caused a whole outcry from some of the soccer community that this sporting event was being used essentially to burnish the reputation of not only fossil fuels, broadly, but Saudi Aramco and Saudi Arabia, I guess, in particular. Now, I will say that that they are not unique, and there are dozens of sponsorship deals, amounting to billions of dollars all across sports and all across football, and Middle East and by extension oil money, is prevalent, essentially in every market, and including the market for renewable energy. So this is just an example, and folks are using it as a way to highlight maybe the continuing influence of fossil fuels, shall we say gently, on the public discourse and public policy.
Yeah, I mean, that's what I was just going to get at. My main question from this article was, why does Saudi Aramco feel the need to advertise in the World Cup? Aren't people just going to buy the oil that they need? Why do they need to kind of burnish the credentials of Saudi Aramco?
Yes, they are indeed going to buy the oil anyway, and these days at a much higher price. Saudi Aramco, in the middle of all this, reported its earnings for the first quarter, a net profit of $32.5 billion, up from $26 billion, I suppose, last year in the same period. But oil companies are indeed doing very well. But they and the countries behind them are trying to diversify their economies, diversify their revenue streams, get ready for the post-oil future, the EV future that's coming. So there is a public relations battle and a public conversation underway they want to influence.
All right, well, you can read Dimitri's piece on sports washing in the World Cup on ImpactAlpha.com. There's also a link in our show notes. But that's going to do it for this episode of This Week in Impact. Thank you for joining me today, David.
Always a pleasure, Brian.
And thank you all for listening. This Week in Impact is a production of Impact Alpha and part of the Impact Alpha podcast network. Smart conversations by and for impact investing professionals. For exclusive stories and insights about the world of impact investing and sustainable finance, join thousands of other agents of impact by subscribing. Just go to impactalpha.com/subscribe for full access. Thanks, as always, to our producer extraordinaire, Isaac Silk. For David Bank, I'm Brian Walsh, Managing Director of the impact advisory firm Human Nature. We'll see you next week for more Impact.